In the 2023-2024 audit cycle, Mole Municipality was hit with a 27.3 million rand impairment penalty by the Auditor General. The finding exposed the failure of their legacy accounting. The municipality relied on an incurred loss model, providing for doubtful debts only after an account had already defaulted by using static percentages applied to a spreadsheet. The revised GRAP 104 accounting standard prohibits this backward-looking approach. Municipalities must now anticipate future credit losses from the date of initial recognition. Under the ISA 540 auditing standard, these estimates are considered high risk. Auditors demand mathematical proof for every provision, making Mole's previous flat 10.25% high-risk penalty indefensible. Surviving an AGSA audit requires replacing the traditional black box with an algorithmic, forward-looking financial architecture. The expected credit loss equation calculates risk through 4 variables: probability of default, the likelihood of non-payment; loss given default, the unrecoverable percentage; exposure at default, the balance at failure; and a discount factor, capturing the time value of money. Executing this equation across thousands of billing accounts requires an automated pipeline. Raw data must flow through an enterprise-grade architecture using Python and DuckDB to ensure the math is reproducible. This system treats the expected credit loss as a continuous financial model that reacts to shifting customer behavior and macroeconomic conditions. Processing metropolitan-scale datasets, like those in the city of Johannesburg, requires extreme data integrity before any modeling begins. The first business rule in the pipeline involves isolating credit balances. Because an account with a negative balance represents a liability, a payable in advance, it cannot be classified as an asset. Leaving these negative balances in the dataset would artificially deflate the total exposure of defaulted accounts, leading to a data integrity failure under ISA 540. Once the data is cleaned, the model segments the accounts. Using k-means clustering, the system sorts debtors into homogeneous risk pools, separating commercial entities from indigent households based on their actual payment behavior. The architecture also filters contractual receivables governed by GRAP 104, such as water bills, from statutory receivables like traffic fines under GRAP 108. This ensures that the predictive models are only applied to data that has been forensically scrubbed and categorized to meet the Auditor General's standards. With the segments established, the engine calculates the baseline variables, starting with the exposure at default. This figure includes more than the current invoice balance. The algorithm must also estimate the continued water or electricity consumption that occurs before a physical service restriction is executed. The pipeline then applies the discount factor. This is a critical requirement for handling the large balances often owed by the Department of Public Works during property registration moratoriums. Government departments carry a unique risk profile. They have a 0% chance of bankruptcy, but they frequently present a severe delayed payment risk, stalling cash flows for several years. The model handles this by discounting those delayed cash flows back to the reporting date using the effective interest rate. This prevents a material misstatement by acknowledging that R1 million received today is worth significantly more than R1 million received in 3 years. The model determines the baseline likelihood of failure using Markov transition matrices. These track the percentage of debt that rolls forward through aging buckets from 30 days late to 90 days past due. However, the revised GRAP 104 standard prohibits municipalities from relying solely on this historical performance. To meet the requirement for forward-looking information, we use the Vasichik single-factor copula model. This curve represents a historical average default rate of 15%. The Vasichik model links this historic average to macroeconomic indicators like GDP and inflation. When a negative z-factor weight is applied to represent a recession, the distribution curve skews to the right, pushing the expected loss rate up to 24.8%. This mathematical calibration ensures the provision reacts to the local economic cycle, such as an agricultural drought affecting the community's ability to pay. The accounting standard further requires evaluating a range of outcomes. The model splits the forecast into 3 probability-weighted scenarios: baseline at 60%, optimistic at 10, and a pessimistic stress test at 30. Aggregating these three scenarios produces the final point-in-time probability of default used in the calculation. The expected credit loss provides a macroeconomic forecast applied to individual utility bills, connecting local behavior to the health of the national economy. Beyond national economics, the model incorporates hyper-local data from the city's infrastructure delivery and management system. There is a behavioral correlation between municipal service delivery and revenue. If a municipality faces high electricity distribution losses or failing physical infrastructure, communities will often withhold their payments in protest. The Python architecture codifies this by using predictive conditional logic to penalize the baseline probability of default based on ward-level service data. For instance, if a ward records electricity losses greater than 15%, the residential probability of default inadequate based by a 30% penalty. Financial impairment is tied to engineering reality. A failure in the physical power grid leads directly to a loss on the balance sheet. All these variables, from historical transition rates to the service delivery penalties, collapse into a single output, the dynamic provision matrix. This matrix assigns distinct risk trajectories to separate categories, such as applying specific loss rates for low-income residential households versus commercial agriculture. These algorithmically derived percentages are multiplied against the outstanding balances in each bucket to generate the RAND value journal entries for the financial statements. To support these figures, the municipal accounting policies must be updated to document these default parameters and the probability-weighted scenarios. The final provision matrix represents the mathematical output of millions of behavioral data points and economic forecasts, providing required support for the annual financial statements. This level of rigor is designed to withstand the scrutiny of the Auditor General and the ISA 540 standard. The Python architecture provides an auditor portal that allows the AGSA to view traceable code hashes and visualization plots explaining the drivers behind the credit risk. This transparency allows auditors to verify the mathematical derivation of every cent provided for, ensuring the provision is not considered arbitrary. For the CFO, this system serves as a strategic tool to predict cash flow shortfalls and target credit control interventions before accounts become unrecoverable. Adopting the revised GRAP 104 framework updates the South African municipal treasury to meet modern accounting standards while improving internal financial control.